Hello, my name is Denise Martin. I'm with Group 5 of the Management 3600 debates. This is the con discussion of With the Economy on the Mend, it's time for more businesses to launch IPOs. Initial public offerings, or IPOs, are the first sale of stock by a private company to the public. IPOs are often issued by smaller, younger companies seeking the capital to expand, but can also be done by large, privately owned companies looking to become publicly traded. It's important to think twice about the wisdom of the decision to give up control to stockholders of a company that one has devoted many, many hours to nurture in the effort to increase available financing. Restrictions and requirements increase workload. It can be a year or more to prepare an IPO. Discussions are a time-consuming distraction for current small and medium-sized businesses. Financials paperwork cause loss of focus on business, which in turn may cause decline in profit that can put a dent in stock price run-ups. In an IPO, the issuer obtains costly lawyers, accountants, and investment bankers to determine what type of security to issue, common or preferred, the best offering price, and the time to decide to which market to bring it to. Underwriting firms such as Goldman Sachs have lost credibility the last several years in terms of bailouts and insider trading accusations. When a company becomes public, it is open to investor and government scrutiny. SEC oversight and the Sarbanes-Oxley regulations requires the type of transparency that openly tracks executive salaries and other compensations that often annoy stockholders. Public audits, annual and quarterly reports must be overseen by competent and costly CPAs. The company must be creditworthy and demonstrate positive cash flow in order to attract investors in today's uncertain economy. The price-to-earnings ratio, an equity valuation measure defined as market price per share divided by annual earnings per share, in many of today's submarkets tend towards overvaluation. IPOs can be risky investment for the individual investor. It has no price-to-earnings rating, and it is tough to predict what the stock will do in its initial day of trading and in the near future, because there is little historical data which to analyze the company. Also, most IPOs are of companies going through uncertain transitional times, making it difficult to gauge future values. Inexperienced management are pressured to maintain profitability while having no basis to predict future stock prices. Cash-strapped CEOs and CFOs should wonder whether it's worth the extra 20% of their time, worth the risk, and worth the expense to venture into the NASDAQ or other public domain when it is unknown if the economy is truly on the mend or at an inflection point headed for another downturn.